in listen-only mode.
Good morning everyone and welcome. My name is Laura Love and I work for the Innovation and Development Group in the Office of Local Government. My position is Senior Policy Officer Finance. I'm joined here today by fellow staff members who I have no doubt some of you know very well. Sonia Hammond, Principal Performance Analyst, and Sarah Gubb, Senior Performance Analyst from the Performance and Compliance team. I'm also joined today by our assisting expert consulting team, Caseware, and I would like to thank Caseware for providing the professional knowledge and expertise for this webinar and for the production of the Accounting Code 23. Before I introduce others, let me address the purpose of this webinar and then give a quick overview to the format of this presentation. The webinar is to provide information regarding the disclosures which will be required for the 30th of June 15 financial statements due to the introduction of AASB12, the disclosures of interest in other entities. The webinar will cover AASB10, consolidated financial statements, AASB11, joint arrangements, and AASB12. Carmen Ridley, who wears many hats, including being a member of the Australian Accounting Standards Board, is a Caseware consultant and a principal of Australian Financial Reporting Solutions. Carmen will be presenting this webinar today. We will be seeking only written questions during and at the end of the presentation. Questions will be answered where we can whilst we progress through the seminar, with any curly questions saved up for Carmen at the end of the presentation. We're envisaging that probably most of the questions are going to be more specific to individual councils, so maybe some of those questions may be required to be answered thereafter the webinar, and they will be emailed directly to you. Joining us also today is Gary Motto, who also wears many hats. Gary is a Caseware consultant and a principal at Hills Rogers Spencer Steer. Gary will assist in answering questions throughout the webinar. Next slide, please, Carmen. But before we dive into the webinar, I would like to have everyone test the functions of their webinar session. I understand that several councils have been using webinars, but for those not familiar with the software, we will do a run-through. I trust everyone can see the webinar audience member screen in the presentation to the right. We won't be using voice questions at the end of the we won't be using voice questions at all, actually, because we had experienced technical problems with this, especially with such a large audience, and we're expecting about 81 to attend today. However, feel free to test the written questions now if you wish. Sonia and Sarah will send you a response. If you wish to discuss any matters in person, please do not hesitate to contact the relevant Office of Local Government staff. As I mentioned before, with the question process, we have attempted to set up the system so no one can see the name of the person asking the question. And if we provide a public response, everyone will see the question and answer, but not who asked the question. Where answers may be relevant to all, we will answer them publicly, or alternatively, if you want a question answered privately, just type private in the text box before asking the question. As I said before, Carmen will attempt to answer those that she can at the end of the session, but as they're most likely to be specific to a particular council, we may save those up and reply to you in writing. Also, if you have any other questions that you think of when this presentation has finished, or for those who are not attending the presentation today but will be listening to it, you can send those questions through to our email address, which is code@olg.newsouthwales.gov.au. Now that all the housekeeping is done, let's get started. Over to you, Carmen.
Thank you, Laura.
Welcome everybody. I guess we've got about an hour today to go through these three standards that are fairly major standards. For-profit entities had to adopt them last year, so we have seen I guess some of the problems with implementation of these standards. What I will aim to do is give you an overview of them. I can't turn you into an expert of the three standards in this time, but we'll go through the theory of AASB10 and AASB11, which is where all the recognition and measurement criteria are. And then the way that we will approach AASB12 is I've actually pulled in some extracts on what we put out in the appendix last year as our proposed disclosures. These aren't the final disclosures to go in the code. It may well change a little bit, but it will just give you an indication of the type of disclosures that are needed. So I guess to start off with first, just a bit of the interaction on how these standards work. There are three brand new standards. The first question that we need to ask is, do we control an entity in our own right? Now control, we'll go through what that definition is. It's not the traditional control definition that we're always used to, where we're looking at 51% of voting rights. Very much it's a substance definition, and that's why we're expecting to see a number of changes in the not-for-profit industry, particularly where we're looking at investments where they don't necessarily have any shares. It is something that we satisfy that definition because of the substance of the relationship. So if we look at that and we say yes, we control it, then AASB 10 is our relevant standard. That's the standard that tells us what we consolidate and how we go about the consolidation process. I guess the good news is the consolidation process has not changed. It's identical to the way that we all learn consolidations. You'll see on the slide, so I'm down on the left-hand side now, we've got underneath consolidate in accordance with AASB 10, we've then got AASB 12 disclosures. So AASB 10 and AASB 11 do not include any disclosure requirements. All disclosure requirements have been pulled out of those standards and have been included in a separate disclosure standard called AASB 12. So that's why we talk about that in relation to disclosures. That doesn't include any recognition and measurement, purely just disclosures. If we then go down the right-hand side of this decision tree, we say we don't control in our own right. We then need to look and say, do we have joint control? And we'll have a look again a bit later in the presentation about what does that mean. If we say yes, we've got joint control, then we have another decision to make. We have to decide whether our jointly controlled entity is a joint operation or a joint venture. Same terminology with joint venture that we've had in the past, but it has a different meaning under this standard, under AASB 11, and again we'll have a look at that. We can see we've got the AASB 12 disclosures as well. Kicks in for these investments at the same time. If we say we don't have joint control, we then ask the question that do we have significant influence? And if we say we have significant influence, the accounting for our associates and our joint ventures is identical, both equity accounted. If we don't have significant influence, then we treat whatever we've got an investment in under the financial instrument standard. So slightly different references there for the standards. We've got the financial instruments standard and the financial instruments disclosure standards. So that's kind of how everything fits together. What we'll focus on today, as we've said, is AASB 10 through to 12. The effective date for this standard for not-for-profit entities was 1st of January 2014, so 31st of December 2014 and 30 June 2015 for you guys. And why did we change that? Because we released guidance at the board level to try and help not-for-profit entities, and we just grouped not-for-profit, private and public sector together. So we believe that a lot of the terminology in this standard would have been difficult for not-for-profit entities to implement. So the guidance we released was to try and assist not-for-profit entities to interpret the requirements of this standard. We were very clear that we did not want to change the requirements. We expect that not-for-profit entities will still completely apply AASB 10 in its entirety. All the guidance does is give a bit more information about how to do that. The standard that we released, AASB 2013-8, still sits alone as a separate standard at the moment. It will be incorporated as an appendix to AASB 10. And I would strongly encourage all of you to read that. There's lots of worked examples in there. I haven't got time to work through them necessarily today, but there are lots of worked examples within that. we did not intend to provide an example for every scenario. What we intended to do was to try and give some examples to illustrate some of the principles. So as I say, I really strongly encourage everybody to have a look at that. So let's get into what the detail of the standard says. From an overall perspective, it says that if an entity is a parent, it needs to prepare consolidated accounts. And we've got some definitions there on the slide. It also tries to give one consolidation model. So in the past we used to have a number of different consolidation models. One for our traditional type subsidiaries, one for the SPVs or the special purpose vehicles, special purpose entities that were set up. The International Board aimed to just have one model for all entities. So AASB12 and its definition of control is intended to apply to everything. So what is this great definition of control that I keep talking about? Here it is shown on the slide. 3 distinct components to this definition, and each of them need to be satisfied in order for control to be achieved. So the first one is that we have to have power over the investee. We have to have exposure or rights to variable returns. And because of the power that we have the ability to affect the returns that we're going to get. So if those 3 components are satisfied, we are deemed to control an entity. Regardless of our shareholdings, we may not even have any shareholdings. They're the 3 distinct components that we need to look at. So we'll work through each of those. Few key concepts to think about for not-for-profits, and as I say, we've referred at the board to not-for-profits, meaning private and public sector, so the councils are completely incorporated in this. I'm just referring to the terminology in the standards. We don't need to have a financial interest to be able to control an entity. So in the past, I think there's been a tendency to say, well, we don't hold shares. We don't have a particular dividend stream or any management agreement for cash to come back up. Under this standard, it really doesn't matter. It's focusing on the substance of the relationship. So we're looking at entities that the councils would have a relationship with, rather than necessarily that traditional word of an investment. We're looking at where a relationship exists. Doesn't need to be a related party necessarily under that definition. It's just where we've got 2 entities and there is that relationship there. So I guess the first thing we've got to do is identify what type of entities we should be considering when we are looking at this control. And it may be entities that in the past we haven't even considered controlling them. It may be, as we'll see as we go through the slide, that we'd still say we don't control, but there's still disclosures that are required. So let's look at what's power. When we're looking at power, we're looking at the relevant activities of an entity. So we're saying, what does this entity do effectively on a day-to-day basis? What is it in business for? What is it in operation for? And it could be that it's out there providing a particular service to a certain section of the community. It could be that it's out there trying to provide funds for somebody, to actually acting as a philanthropic type fund. So we work out what it is that that entity does, and we're looking at who has power over those relevant activities. Who are the ones that get to slam their fist on the table and say, I disagree with the rest of you, and because of this power that I have got, my decision counts. We're looking at who's got the power at the time that the rights are made. So it's all very well if perhaps there's an agreement that expires in 3 years' time, and in 3 years' time we're then going to take over and we'll have the power, but until that agreement expires we don't have the power. It might be that some of the subsidiaries or some of the entities we're looking at do have shareholdings, and there may be voting rights in place, and we don't just look at the voting rights currently in place. What this standard requires us to do is to look at the potential voting rights, any other contractual agreements in place, anything in place that says that actually we have to have unanimous consent, or we have to have one party who actually has the casting vote in a particular situation. So where you do have an investment in a subsidiary or potential subsidiary where there are voting rights, we don't just look at the existing voting rights, we have to look at other agreements that are in place. From a not-for-profit context, this is some of the guidance we've given in the standard. We've said that often the power arises because of agreements. that are in place, so admin agreements, statutory provisions that have been set up. And when we're looking at power, some of the things that we might be looking at is who's got the right to give policy directions. Who is the ones who actually says, yes, you guys are down there running that particular entity, but we have the ability to tell you what to do in a general context, in a strategic context. We might also have the right to approve or veto operating or capital budgets. And if we've got that right, we've got the power, because whilst there may be a management committee, for example, who is down running a particular entity, if they have to run everything through us, we've got the ability to veto or approve those budgets. Then we're actually the ones who've got the power, because we can stop them doing what they want to do. So when we're looking at power, we're looking very much at who has the ability to control what they're doing, to run their activities. And what might exist practically may be different from what has the ability to exist. What we do have to consider, however, is the rights that we have to be substantive. As I said, we have to have the practical ability to exercise the right. We also could differentiate between some rights called protective rights. And those rights exist, but really to stop somebody doing something. So a few examples there on the slide. The ACNC would have the right, or the ATO would have the right, to remove the tax deductible status for any entity. Now arguably you could say, well, that gives them power, because if you haven't got tax deductibility, can you do your operating activities? But under this standard, that's deemed to be a protective right. That right exists to stop that other entity going off and doing something completely haywire. Those rights aren't the ones we're looking at. We're looking at ones where we can actually gives us the ability to get in there and tell this entity how they should be running their particular business, what they should be doing in order to fulfill their objectives. If all we've got are protective rights, we do not have power. We may have substantive and protective rights, and in which case that's fine, but if all we have are those protective rights, we don't have that power. We may find that we have substantive rights, but because of various reasons, we're probably never going to impose them. Now the standard says, well, that's okay, but the existence of those rights will still give you the power. So the example that we've given in the standard is a railway authority, and the government has the ability to go in and remove the board of that railway authority without just cause. The board members do not need to have done anything. They can go in and sweep the board. Realistically, is that going to happen? Probably not, because for political reasons it doesn't look good for the government, the big bad government, to be going in and wiping the board for no reason. So it's probably never going to be exercised. However, they have the ability to do it. So having that ability, regardless of whether they will use that, is still considered to be a substantive right. So we need to think about that when we're thinking of power. We can't say, well, we're never going to actually exercise that. It doesn't matter. If you have the ability to exercise, then it is something that we take into account in our power assessment. The second component that we need to look at is in relation to returns. The standard setters deliberately used the word returns rather than benefits because they wanted to show that it may be positive or negative. Now some of the more common ones that we see are the likes of dividends, and if you do have an entity where you've got shareholdings, it may be that you receive a dividend. It also may be, however, that you receive management services fees. It may be that you receive returns that you wouldn't be able to get from anybody else. Any other investor wouldn't be able to get those returns. There's a number of different people have an interest in this organisation, but you get the returns. You're the ones who've got the ability to use most of that service that they're offering. For example, a tip site. It may be that you've outsourced that and other people can use it, but if you turn around and say, we're actually the ones, we need to use it 100%, we've got the ability to use it as much as we want, and we've got the ability to shut other people off from using it, that could be a variable return that we've got. The standard does acknowledge that lots of people might actually get variable returns. However, there is only one party who is deemed to control. Generally, I think this one is easier to determine than power. However, what we need to bear in mind with a not-for-profit is our returns don't need to be financial. So if we were talking in a for-profit context, we'd talk about financial, we'd talk about funds being received. In a not-for-profit context, what we're also talking about is we're talking about non-financial returns. So we've set up a particular organisation, or a particular organisation is out there doing work for us to help us further our social policy objectives. We're not getting any funds back from them. What they are doing, however, is helping us provide the services that we need to provide to the local community, helping us fulfill those objectives. And that's considered to be a return that we get as well. So don't focus on financial. We are very much looking at non-financial. It is a fairly broad definition of returns. I think practically what I've seen when people have been assessing this is that if you've got power, this one generally falls out, because you wouldn't set up a not-for-profit organisation who wasn't doing something to further your objectives. And then the third component really just ties the first two together. If we've got power and if we've got access to variable returns, then we've generally got the ability to affect the returns that we're going to get. Because of the power that we've got, because of the ability to tell these guys what to do and how to run their business, that affects the returns we'll get, the furtherance of our social policy objectives. So they're the three distinct components that we've got. We need to satisfy each of them. If we do satisfy each of them, then we have got control. I might just pause there a moment, Laura, and just see if any questions have come through just on those three themes. Anything needs answering. I'm guessing nothing's come through. All right, I'll carry on. So an example for you. This is a for-profit oriented example, but it draws out some key things. So what I want you to do is just spend a minute having a read of this particular example, and in your head as you're watching it, who controls entity E? Now, I'm not going to get you to press any voting buttons to tell me who you think controls, but if I was to do a straw poll, quite possibly I would have about 60% who would say that entity F would control. So when we're looking at this, it shows us some of the things we have to think about. We have to look here at percentage holdings. What we also have to do is look at who sits on the board, who's on the governing body. In this instance, we're told that F has set E up. So it could be that we've set up an organisation. Does that mean we automatically control it, however? Not necessarily. There's economic dependence here. And economic dependence is a factor that we need to think about, but is certainly not the only factor and is not an overriding factor. This is actually an example straight from the international standard. And they're saying that they do not believe entity F controls E. And the reason being because we only need to get 6 investors working together to be able to outvote F, and they think that's a reasonable number. They also say that the people where the decisions are being made, those 17 other investors actually have more people sat around the table than entity F. So when we're looking at this from your context, we're looking to say, okay, who does sit on the governing body? Who sits on that committee where decisions are being made? Who are the people acting for? They may be community members, but have we appointed them? And what we're not told here, for example, is who's appointed those 17 other investors. If F had appointed them and they were acting in the interests of F, then our control decision might move. So we're required to investigate a lot more into who are the other interested parties of anything that we have set up. What is the purpose of the particular entity that has been set up? What is the design of it? Did we set it up? Why did we set it up? If we didn't set it up but we're taking an interest in it, or we've got some sort of power over it, we need to take all of these into account. Whereas in the past, we would probably just have ignored these type of entities. Entity F in this example would probably not have even considered it because it never crossed that magic 50% mark that we used to take in the past. Another thing that we just need to think about is the agency versus principal relationship. Now this is where you have delegated some of your power to somebody else. So you have to provide a certain service and you might have delegated somebody else to do that for you. We need to look and say, what kind of relationship have we got with this entity? We need to say, okay, we've delegated power to them. What power have we actually delegated? We might say, what does the contract say? But what also is happening, what is the best or the common practice that happens? Can we go against that contract at all? In certain circumstances, we might determine that we've delegated power to such a sufficient level and we've given this person we've delegated power to that they're actually acting as a principal of the relationship rather than as an agency for us. If they're acting as an agent, we probably would have to consolidate because they're acting in our interest. If we've delegated so much power down there, potentially there's an area of our business we are not consolidating. The things we need to think about, we've got one that is conclusive. We look at how we get rid of them. So let's say there's a number of councils have got together and have delegated power for a particular service. They've set up another entity and it's been run by Mr. Smith, Mr. Smith's business. We've got Mr. Smith who's doing all of the operations in relation to that particular entity. One of the councils decided that actually they don't like the way Mr. Smith's business is operating and they'd like to get rid of them. How can they get rid of them? Is it that council number one can say, I really don't like the way Mr. Smith is operating and therefore, thank you very much Mr. Smith, but see you later. They have the right individually to get rid of that particular business. Or is it that that council has to have the agreement of all of the other councils in order to get rid of Mr. Smith's business? The more people that we have to agree to get rid of Mr. Smith's business, the less chance there is that they are acting as agents for us, the more chance there is they're acting as a principal, because it's harder to get rid of them. Those kick-out rights are fairly high. We need to therefore consider they're the ones who are actually in control of that particular business. While we may still have the returns from it, we actually don't have the power, and therefore there may be some instances where we have consolidated in the past that we do not have to consolidate now. The transitional arrangements for this particular standard are, I guess, similar to most of the arrangements we're now seeing in the more recent standards, in that it is full retrospective application. If you have an entity that you have always consolidated and you continue to consolidate, no issue. If you have an entity that you have never consolidated and under this standard you will not consolidate, no issue. If, however, you are starting to consolidate or you are stopping consolidating under this particular standard, it is full retrospective application. Now, what does that mean? That means you apply this standard as if it has always been in place. So we are talking about our 30 June 2015 financial statements. In those financial statements, we would have the 30 June 2014 comparatives. Those 30 June 2014 comparatives will need to have the new entity consolidated. In order to get that closing balance sheet at 30 June 2014, we need to be able to get an opening balance sheet of 1st of July 2013. If you have new entities you are consolidating, they need to be consolidated as at the 1st of July 2013. Because comparatives get restated. At that time, if we have deemed that we have just obtained control, we will also need to look at the business combination standard, because we look at that the first time we obtain control, potential goodwill being recognised, fair valuing of assets and liabilities. If we are deconsolidating and the deconsolidation has not arisen because of any reason since 1st of July 2013, we deconsolidate as at the 1st of July 2013. So one of the reasons that we put that appendix in the code last year is just to give you an indication of the disclosures to sort of allow you to start grabbing some of that information and start thinking about this. So if you have a change, if you have either a new entity being consolidated or an existing entity being deconsolidated, please don't wait until June to start planning for this standard. Please start looking, making sure you've gathered that information now. So AASB 11, not going to spend a lot of time on this, but I understand that some of you do have some of these joint arrangements, so it is important to consider it. So AASB 11 is the standard that deals with joint arrangements. The term joint venture still exists, as we saw from that first slide, but it means something different. The umbrella term now is joint arrangements. So what is a joint arrangement? It is where two or more parties have joint control. Control meaning exactly the same definition that we have just looked at in AASB 10. Excuse me. So in order to have a joint arrangement, in order to even get into this standard, we have to have a contractual agreement that is in place, and that agreement or that arrangement gives the parties joint control. It doesn't say that yes, you both own 50%, but in the event of a dispute, Carmen gets to slam her fist on the table and say, read the agreement, I have the casting vote, my vote counts. It is genuine joint control. Both parties can block the decisions of the other party, or if there is more than two parties, all parties can block the decisions of the other party. Has to be unanimous. If you don't satisfy that definition, you don't get into this standard. So don't just think, okay, we have 50% and another party has 50%, therefore we have to have a joint arrangement. Unless you satisfy that definition, you don't get into here. Once you're in, you then have to classify your joint arrangement as either a joint operation or a joint venture. A joint operation exists if you have not set up a separate entity. So if you haven't set up a separate entity, it automatically becomes a joint operation. Otherwise, if there is a separate entity has been set up, what you need to work out is whether each party to the arrangement has rights to certain assets and obligations for certain liabilities, i.e. I can identify that Council 1 can pull that out because it's mine and Council 2 can pull that out because it's theirs. Or do all parties to the arrangement have rights to the net assets of the thing that we've set up? So nobody gets to pull out individual assets and liabilities. It is just the end result, the net assets. We share that. If we have a joint operation, then each party to the agreement or arrangement accounts for their share of assets and liabilities. If it is deemed that we have a joint venture, then we equity account. So we need to very much understand what type of arrangement we've got in order to determine the accounting treatment. Maybe that you have to change your accounting treatment from previous years. This slide just illustrates the previous slide, but in a decision tree, because I know some people like the decision trees. When we're looking to try and decide whether we have rights to assets, obligations for certain liabilities, we look within the terms of the agreement. We look at the legal form, we look at the substance, we look at any other facts and circumstances to help us make that decision. It can be fairly judgmental, and if it is, then it's a disclosure that we put in our estimates and judgments note. You get very different answers depending on whether you deem something to be a joint operation or a joint venture. A joint venture is just a one line in the balance sheet, interests in equity accounted investments, whereas a joint operation, you are bringing in components of assets and liabilities, so they get added to the relevant asset. Some points to consider about AASB11. The transitional provisions where you are changing can be fairly complicated. So if you are currently proportionately consolidating your joint ventures, and that was an option under the old standard, you are required to move to equity accounting. So you're having to wind back all of your proportionate consolidation, because this is the same as AASB10. It is full retrospective application. So as at 1st of July 2013, you need to have been accounting for this in the way that the new standard requires. So you're presenting different comparatives from those that you would have presented last year. If you are currently equity accounting and you're moving to accounting for the share of assets and liabilities, again you're unwinding that equity accounting. There is a number of illustrations within this particular standard. We have not put out a not-for-profit element of this standard. It is identical to the International Board standard, so the standard for not-for-profits is exactly the same. Just because you had a joint venture in the past, do not assume that you will continue to have a joint venture in the future. Joint venture, regardless of what it says on the legal agreement, has changed the definition. So we've seen what that is, we've worked through that. It's where you've got a share of the net assets. So don't just say we've always had a joint venture, it will be a joint venture in the future. You need to go through and make this assessment. Alright, again I'm just going to pause for a minute to see if there's any questions, because we've finished the recognition and measurement type component. We're moving on to the disclosures. So if any of the guys from the OLG have had any questions that need me to answer, can you let me know?
One comment about how extensively each year do they need to document the decision process?
So how extensively each year do we need to document the decision process? I guess the answer to that, and is the answer to a lot of my questions, is that it depends. If this is something that it is a fairly clear-cut process and you can say, well, this we clearly fall on this side of the fence because, then you don't need a lot of documentation. If it's something you're spending a lot of time trying to work out which side of the fence you actually fall on, your documentation obviously needs to be more extensive. Now, I guess the thing about this particular standard is most of the time when I'm talking about accounting standards, I say do some really great documentation in year one and just roll it forward every year. I can't enter this standard because things change. Parties to arrangements change. It might be that one year we deem that we control, the next year unfortunately we deem we don't. Potentially in year 3 we control again. So this is something that needs to be continuously reassessed. It is not a set and forget standard. So I guess it's every year we need to look at have things changed. The level of documentation again depends on how much judgment you are making.
There's another question up here, Carmen. I'm not sure. Yeah. It says, I would like to know whether these changes could potentially affect the consolidation of RFS activities and assets into local government financial statements.
I need some help from the OLG or from Gary. I'm not sure what RFS is.
RFS is the Rural Fire Services. Now, I think the response I believe would be that many councils have different arrangements with the RFS, and that they really need to go through those 3 criteria and assess with their rural fire service where they have the control. Comment, Carmen? Gary?
Yeah, I would completely agree. Yeah, that we can't give rules around this because, as you say, every council seems to have different arrangements in place, and it really is a matter of going through and reassessing. If you're aware, I guess, as a council that your arrangement is identical to the neighbouring council, or share resources to work out your assessment together, just to try and save time and save effort. But otherwise it's a council by council assessment that has to be done, and unless there's a general agreement across the state on, everybody deals with the RFS the same way, we can't set rules. Any more questions at this stage?
That's all that's up there at the moment, Carmen.
Fantastic. All right, we'll carry on now and look at AASB12, and what I've tried to do in here is to talk a bit about the theory, what does the standard require, and then show how we are going to translate this into the code based on the appendix we put out last year. As I said, this may change, the format may change, but I just want to give you an indication of the type of disclosures we're going to be asking for. So the scope of this particular standard is applicable to all entities that have an interest in any of these type of entities. Now, we've talked about subsidiaries, we've talked about joint arrangements, we've talked about associates in that initial decision tree, so those entities we have significant influence over. The thing we haven't talked about is structured entities. It is only mentioned in this particular standard, so as we go through this standard we will talk about the structured entities. A standard is purely a disclosure-only standard, so it is not a standard that has any recognition and measurement in there. The idea behind this standard, so what the International Board do is they give us a disclosure objective, they call it, and the disclosure objective for this particular standard is shown there on the slide. You can see lots of discussion about the risks that are being faced. And this is something else that as soon as somebody who reviews financial statements, I see those words and I think boilerplate disclosures. People aren't sure what to write. So we need to make sure, as we do with everything else around the code, if it is not relevant to you, if it is not specific to you, if it doesn't describe what you do, please change it. What we're putting in the code is illustrative disclosures. It is not something that we expect every council will do. There are 4 broad categories of disclosure within AASB12. The first one is a fairly general type one. The next ones are ones related to specific investment. So it's almost split out in a chapter by chapter basis, and you have to do the first bit. You then pull out the relevant information from the relevant chapter based on the investments that you have. We in the code have revised the accounting policies as well, in that we've revised the principles of consolidation 1 to include the new definition of what control will be, what control means. We've also given the accounting policies for joint arrangements and joint ventures, etc. Accounting policies are an area that is getting lots of discussion at the moment, not just in the local government, but I guess generally, about how can we reduce them, how can we make them more meaningful. And I guess that what I'm asking councils to do is to actually go through their accounting policies. Don't just ignore them and think they're in the code and therefore I have to include everything in there. Please make sure that you're only actually including what is relevant to you, and that's both in this area. If you don't have a particular type of investment, if you don't have a joint arrangement, delete the section on joint arrangements. Don't leave it in there if it's not applicable to you. But it's also from the whole of the accounting policies. Don't describe things and how you account for them if you don't have them. Significant judgments and assumptions is an area that is done very badly both in Australia and overseas. The purpose of this particular disclosure, which is a general disclosure in AASB 101, is to give information to the users of the financial statements about the significant judgments, guesses that you have made when you have been compiling your financial statements. Why is that important for the user? Because if you've spent time making significant judgment or guesswork, then if you'd fallen on the other side of the fence, what would the results have been? And it's to say to the user, this is where we spent a fair amount of time, to allow them to work out what that impact would have been. What we often see is really boilerplate type disclosures. So these should be specific to the council. Now the International Board have acknowledged that this general disclosure in AASB 101 is done very badly, and what they have done is they have said in every new standard that they issue, if they believe there will be significant areas of judgments and assumptions, they will repeat this disclosure requirement, and they will give us examples of what they believe will be the significant judgments and disclosures. Now, this does not mean that you always have to say why you control an entity. It is significant judgments and assumptions you have made in determining it. If, for example, you own 100% of a subsidiary, clearly you control it. It has not been that you have spent significant amounts of time trying to work out if you controlled that particular entity, and therefore you would not include it in this disclosure. What we would include here is where we've got a situation where prima facie it doesn't look like we do control, but when you drill down, when you look at the power, when you look at the returns, for example the RFS, we've spent a fair amount of time to look at that to say, oh, we think we control it because, and that's what we'd include here. Or if it was that significant, you could almost include the, we don't think we control the RFS because. If people are going to ask the question, it's helpful to answer it for them before it's asked. If we've got joint control, we've got a situation where we're trying to work out whether we've got joint control, and again it's not clear-cut or significant influence, we include that information here. If we've got a joint arrangement and it's set up through a separate vehicle and we've spent time trying to work out whether it's a joint operation or a joint venture, that's the type of information that we need to include in here. So very specific to what we have done. We will include some examples in the guidance in the code. Please do not copy those examples and think, fantastic, now I've satisfied this requirement. You haven't. These are examples that have been made up. They're to illustrate the type of disclosure, not to be used as a, this is the disclosure that is needed. If you haven't made any significant judgments and assumptions in working through AASB10, AASB11, well, don't put anything in. We're looking at things that are very specific to the council. So we'll move through each type of investment now. The first one is in relation to interests in subsidiaries, and these are the overall objectives in this particular section that the International Board want us to satisfy. So disclosures to allow users to understand the composition of the group, significant restrictions, risks that are faced, consequences of changes in ownership. It then goes through and gives us very detailed disclosures on what we need to include to satisfy these disclosure objectives. It then tells us that for subsidiaries that have a material non-controlling interest, we need you to give us more information. Now this is interesting in that, what is a material non-controlling interest? I write the content for caseware, as has been mentioned, their financial reporting. And it's very easy when I write the disclosures in that I write the blank table and I say this is the information that needs to go in for the material non-controlling interests. And then I'm asked to do some sample accounts that I have to make up the numbers. And when I did this particular sample account disclosure and I came to a material non-controlling interest, I thought, okay, well I'll pick 40%. 40% is a fairly big number. That will be a material non-controlling interest. But my subsidiary was quite small. So 40% of quite a small subsidiary really wasn't very material. Which got me thinking, what does it actually mean by this word material? It could be that you have a 5% non-controlling interest, but it is material, either because of the numbers or because of who that 5% is. It could be that it is material because of strategic reasons that this particular entity has been set up and why you have undertaken this particular arrangement. So judgment needs to be made. I have seen a number of accounts for for-profit entities, because they're the only ones who've released under this standard, who have described why they believed a subsidiary had a material non-controlling interest. So to actually let the user know why this was chosen. And in some of those situations, the number wasn't material. It was material because of qualitative reasons. So as you can see from the slide, where our subsidiaries have a material non-controlling interest, there's additional disclosures that are needed. So just to illustrate now those two sets of disclosures for subsidiaries, I've pulled the information out of that appendix from last year. So we have to give information about the composition of the group. So who are the subsidiaries? Where are they incorporated? What's their principal base of business? And what percentage do we own? Are our voting rights any different from the percentage interest? If they are, we need to disclose that information as well. We then have to give information about where we have controlled an entity where we own less than 50%. And that's perfectly acceptable that we would do that, because as we've seen, the control definition does not include that magic 50% number. So where we've done that, we're describing why we've done that. Do we have any significant restrictions? Have we got a subsidiary but for some reason we have to keep all of the funds in there? We actually aren't able to pull any dividends out there, we're not able to pull any management fee out there. The way that the agreement has been set up means everything needs to stay there. It's a restriction about that subsidiary. Are there any guarantees that we've made in relation to our subsidiaries? Then for the disclosures with the subsidiaries with not material non-controlling interest, as you can see, we saw it on the slide, but when you actually put it into a disclosure, there is a fair amount of information in here. So when we're working out, do we have this non-controlling interest? Is it material? We then need to collect a lot more information around that. Now we may have a situation where we have consolidated a subsidiary with less than 50%. Let's say that we have a 30% interest, for example, and it's deemed that we controlled it. We've included that information. We have found in the for-profits, the people who've implemented this standard, they have struggled to get some of this information. Because if you were only a 30% interest, you're then saying to the subsidiary, well, I need all of this information, and they say, you've got no right to, you only own 30% of us. So we have had some times when we've struggled to get the information, which comes back to that pre-planning now. Work out the disclosures you will need to have and make sure you have the systems in place to collect the information that you need. Because you do not want to be struggling in July to try and get this information for your June accounts. You want to actually set up the process, let everybody know what information you need, and make sure that you've got it. I still haven't talked about structured entities, but it is included on this particular slide. I'm going to talk about it a little bit later on. But essentially it's another entity where we have consolidated. We have deemed we have control in this particular circumstance. We just split it out because it's a situation where we might need to provide funding to that entity. There may be an agreement in place that says we have to provide funding. There may not be an agreement in place. We might just provide funding because if we don't, this organisation is going to fall over. We then need to describe if there's been any changes in the council's ownership interest. Those changes have occurred, but we have not yet lost control. We are still consolidating the particular entity. We also have to describe where we have acquired any ownership interest during the year. We already controlled the organisation. It may be that another council pulled out and we acquired their interest. We had control in the first place. We still have control now. We need that information being disclosed. If obviously you haven't had a disposal of interest or an acquisition of interest, you don't need to include this information. That's subsidiaries. Moving on now to joint arrangements and associates. This is grouped together in one chapter in this particular standard. In the code, we will split it out. We will have joint arrangements and then associates in different notes. For this illustration, I've combined it rather than repeat the same slides. So all of the illustrative disclosures here refer to joint arrangements or joint ventures. It is identical disclosures to associates. So what are we required to do here? Again, we're required to talk about the risks. We can also see from that last bullet point on the slide, we are required to make that materiality assessment again. For joint ventures that are individually material, we need to make the assessment about extra information that we need to put in. How do we make that assessment about materiality? Well, again, it's a judgment call. It might be that the joint venture is not that big, but because of strategic reasons, it's actually material to us, qualitative reasons. You'll notice on the slide, and you'll notice as we go through, I have called things joint ventures. That's not a typo. The standard does differentiate and has extra disclosures for joint ventures rather than joint operations. So some areas it talks about joint arrangements, and that's regardless of whether you've got a joint venture or a joint operation. Others it only refers to joint ventures. Please do not include extra disclosures where you don't need to. If it talks about joint ventures, it means it is not applicable for joint operations. So some of the disclosures needed, as I said, these are identical for associates. I've got "and associate" in brackets at the top, but the slide itself will only refer to joint arrangements. So similar to the subsidiaries, we have to describe who it is that we've got, what's the type of the joint arrangement, the percentage ownership and the voting rights. We have to describe effectively why we set up the joint arrangement. What are the activities? Is it strategic? What was the purpose behind it? We might find that it's useful to talk about who the other parties to the joint arrangement are as well. Information to tell a story to the user about why we have these joint arrangements. From a joint venture perspective, we then have to give information for material joint ventures and also the material associates. And you can see the information here on the slide as well. So we've got a description generally at the start of this to talk about the same year end. There's no significant restrictions, assuming that there isn't. Again, if there is, you'll need to change that. And then the information in the table there on the right is for material joint ventures and material associates on an individual joint venture basis. It is not aggregated together, it is on an individual material basis, individual joint venture basis rather. Again, fair amount of information that is required. These headings are from the standards. It is the summarised information and what the standard believes should be included in that summarised information. We then need to reconcile. So we have accounted for joint ventures and associates using the equity method. What we are required to do is to reconcile the carrying amount to the summarised financial information. So we take our group share of net assets and get back to what are we actually carrying it at. Pull in any reconciling items. We have never had to do this in the past. This could be a challenge. We do have to do it for comparatives as well. So practice and do it for your 30 June 2014 accounts. Making sure you understand how the disclosure is put together. Have you got systems in place to capture the information? If there is a quoted price for any investment that you have, you've got to give that information. I'm not sure if any of you would have a joint venture with a quoted price. We'll do some research into that, and if we don't believe there are any, one of those items that we'll probably push into the guidance. Then we can't ignore those joint ventures that are not individually material, and this is again joint ventures and associates. So what we do, we take our joint ventures, we pull out the individually material ones and we disclose all of those separately. Then all the rest that's left, we add them together. So we aggregate all those non-individually material items. Remember, we are looking at qualitative factors, not just quantitative factors. So it could be that something is material but not very large, but for strategic reasons. And we give information about those together, as I say, aggregated for those non-material ones rather than on an individual basis. If we have any unrecognised share of losses for our joint ventures or associates, because equity accounting, we stop when we hit nil, we don't have negative investments. So if we have not recognised any losses, that disclosure is required, as well as any contingent liabilities or commitments that that particular joint venture has. The last part of this standard covers off structured entities. So the definition is shown there on the slide. An entity that has been designed so that voting or similar rights are not the dominating factor in deciding who controls the entity, i.e. they've been set up through some sort of agreement, through some sort of legislation that actually gives control. Now we saw that we had consolidated structured entities, that was included in the subsidiary part. Account for those exactly the same way that we would for a normal subsidiary. We just give extra disclosure about funding requirements. What we also have, however, is unconsolidated structured entities, and that's why they're covered off in the disclosure standard, because we are required to disclose information. So some examples that we might have shown here on the slide. Each council may well have these structured entities, and they may say we don't control them, and that's fine, but if they exist we still need to consider them both from a control perspective and also from a disclosure requirement. Because if we have these unconsolidated structured entities, we are required to disclose information about them. Again, the disclosure objective is at the top of the slide. Some examples of the disclosures that are required are mainly around funding. How much funding have we provided to this entity? How much funding do we expect to provide in the future? Why are we providing the funding? Is it because we have to, because of an agreement? Or is it because if we don't, this entity is going to fall over? So potentially there are some areas where councils have these structured entities, have never disclosed any information in relation to them in the past, and we will have to start seeing this information being disclosed, explaining to the user why they are being funded. The disclosures that we have got at the moment in relation to unconsolidated structured entities are shown here on the slide. It's another of those areas that we may, depending on feedback, we may push it into the commentary rather than leave it in the main area. We're doing some research again into how many structured entities or unconsolidated structured entities a council would have. We're trying to put things that are relevant to the majority of people into the main body, and other things we pull into the guidance. So please read the guidance as you go through the codes. So if we've got these interests in unconsolidated structured entities, again we're describing them, we're giving information about them. We're saying how we determine that they are structured entities. We're looking to say, have we transferred any assets to them, or is it assets being PP&E, which may have a different fair value to the carrying amount that we've transferred it at. Otherwise, is it cash that we've transferred over? We have to describe the risks that we're exposed to. So have we guaranteed anything for these structured entities? If they fall over, what's it going to mean for us? We talk about the maximum exposure to loss. Have they got any contingencies? Things that aren't necessarily booked, it's just floating around that potentially we have a responsibility to top up. So where we've got these unconsolidated structured entities, there is a fair amount of disclosure around them. Why? Because we're saying we've got a responsibility for them. We don't control them, but we've got a responsibility for them. Still in the disclosures for unconsolidated structured entities, this is where we describe the financial support that we've provided and why have we provided this support. Have we got any current intentions to continue to provide that, and how much do we think that will be in the future. So my thoughts on AASB12. These disclosures are minimum disclosures. Now I know a lot of you are thinking, good grief, there can't be minimum disclosures, they're ridiculous. And they are quite a lot of disclosures. But the aim of these is to make sure that we're telling the story. So if we find that we want to actually describe more about our joint arrangements or more about our subsidiaries and why we've deemed that we control them, there's nothing stopping you put that extra information. We can't, however, knock these disclosures out unless they are immaterial or non-relevant to us. So we need to make sure that all of the disclosures in relation to these investments are actually telling the story that we need to be told. And I'll throw it back now to see, have we got any more questions coming through on any of these that we've talked about?
Yes, we've got a few that have come through. I'll just hand over to Sarah Gubb first. So there have been a couple come through, Carmen. One of them was apparently paragraph 4.1 of the old AASB 127 required only consolidated statements but not holding companies. Is this replicated in the new standard?
I haven't got the old standard in front of me. The 127, which was consolidated and separate financial statements, was that What was the paragraph number again?
43.1. Oh, 43.1.
43.1. From memory, that was in certain circumstances. These standards do not tell us when we need to prepare consolidated and separate financial statements. Now, it may be that I'm throwing back to the OLG guys. The Corporations Act was changed to say that entities who report under the Corporations Act only prepare consolidated accounts. From your perspective at the OLG, and I don't know if this is a question to answer to everybody later, do you currently require consolidated and separate financials? It's not an accounting standard question. The accounting standards try not to get into that space because it's jurisdictional specific. I don't know if you have a preference about whether it is council plus consolidated or whether you only need consolidated. And I don't know whether that's you or Gary or to take on notice.
We'll take that on notice. I think have discussions about that one before we make a decision. So we'll come back to that one. Another one that's come in is also, I'll just scroll down. County councils, and Gary might be able to ask us about this. What's the opinion of the county councils that are not currently accounted for in council's financial statements? Are you able to answer that, Gary? Or do you have an opinion?
Yes, Sarah, I think the answer is similar to the answer that was given earlier about RFS assets. The county councils will depend on the specific arrangements that each council has, but we do expect that if they aren't already accounting for their interests, certainly these standards will capture that.
Okay, so that's it. We've got to go down the wrong way. And there was one more. What about with judgments and assumptions that are disclosed? Does council need to disclose on why some entities or arrangements have not been included, as opposed to those that are included?
If you have spent a fair amount of time working through an assessment process and you've come out with the answer that they haven't been concluded after a fair amount of analysis, then I would say yes, because I think it's still captured by that judgment and assumption. If, however, you go, you know what, hasn't been consolidated, fairly obvious it wouldn't be consolidated, we haven't spent a lot of time on making that assessment, then I would say no. So again, it's my depends answer.
Okay. So that might be a council discretion one then.
Definitely. The estimates and judgments are very council specific. It completely depends on where you have spent your time.
Okay. Okay, and there was one more that just came in. Haven't had a chance to... Oh, there was one about the joint organisation, that some councils with the new reform process out there are going to be part of the joint organisation pilot, and assume we need to ensure that the requirements of these standards will need to be discussed by the pilot committee. Basically, with the joint organisations in its early stages, again, it depends on how that joint organisation will be structured, and so yeah, it's watch this space. But I don't think we're up to that stage yet with joint organisations. But certainly, where there is a joint interest and you know, in terms of financials or whatever, voting rights and blah blah blah. Yes, it will have. You know, they will need to have some consideration in terms of these standards, and depending on what the structure of the JOs are in the end, because they haven't been determined as far as I'm aware at the moment. So another one's coming that if councils have completed its financial statements other than those disclosures, but it does not have the information from other organisations who have not completed their financials, e.g. a regional library, which will have to be included.
So I think that question is saying, okay, you've done everything to meet the time frame, but the other organisation hasn't. What do you do to try and get the information? That's part of my let's plan now. Because if it is material for you, you need to have that information. If the numbers aren't material, that's possibly a different matter. But if the numbers are material, they have to be included in your financials. So as we start planning now and working out what information we need and who we need it from, even if the library, for example, hasn't completely finished their process, have they got materially there so you can pull those numbers in? I don't know, Gary, if you've got, as an auditor perspective, if you've got any other views.
No, I agree with that, Carmen. Just we confront that position at the moment in terms of disclosing information. If it is material and need to be included, there are other ways of bringing into account information that if the balances aren't material, they can still be disclosed, and then subsequently report in a future reporting period. But yeah, I agree with your answer that you've got to plan for it and have that information ready to disclose. Otherwise you can't complete.
And the last one at this stage, and we'll move on from here. Can you provide some examples, Carmen, please, of unconsolidated structured entities?
I guess what we're looking at here is an entity that has been set up, for example, it could be a tip, and it has been set up. You are providing funding to that tip. They are outsourcing the service for you. You say you don't have control. Those guys are out there running it for you, but you're the ones actually giving them the funding to make sure they can continue. The agreement in place says you will continue to fund them because you need to be providing that tip service. So it's entities where you've set up an agreement where you will provide funding, where you have got an input, but you don't control it. The control is not determined via voting rights, but it is an entity where you are sending funds to them.
Okay, so I think that's probably all for now. Anything else we can take on notice and get back to you about them? Gary, from an audit perspective, is there anything you'd like to add in terms of the standards moving forward in this financial year and future one?
Yeah, I think like the other questions that have come through relating to future forums and entities not disclosed, I think they are general type questions which we can probably list the questions and gather our responses and publish those. That would probably be a good way to address those other questions. But generally, yeah, the strategy of dealing with these three standards and giving notice that they're going to come in for 2015 has given us that lead time, so that we're in a good position in being able to discuss these issues now in November, and also the benefit of doing this and the questions that have come through the webinar today and our research on those will help us get a better draft for the code.
Yep. Okay, thanks, Gary. And I agree with regards to the forum. Maybe we can set up some mechanism where that this information can feed through to everybody, both those in the know and those who don't, so that by the time we get to the reporting, then everyone's sort of aware of what they need to do. So I think it's quite important. Yeah. All right, Carmen, is there anything else you'd like to add?
No, I don't think so. I think the key message is start thinking about this early and work through. Don't just take this webinar and say, okay, now I understand all about these standards. Please read through the guidance that is out there and the accounting standard that has been released to try and get understandings of how it fits within your organisation. As I said, every council will have different agreements and different arrangements, so we'll come to different answers.
Okay, thanks, Carmen. And just for everyone there who attended today, thank you very much for attending this webinar. I'm sure you'll have lots of other questions talking to constituents. Please send, at this stage, send any further questions to code.olg@newsouthwales.gov.au, and we will send out the webinar and the questions and answers to you, early next week, as soon as we can gather all of that together. So yeah, if you go from there. Thank you very much. This session will now end. Thank you.